Hi, welcome to another episode of Money Script Monday. My name is Brian Manderscheid. Today I want to answer the question, will the 7702 guideline changes open up the IUL floodgates? Now, I've always heard in this industry that life insurance is always sold, never bought. That certainly wasn't the case in 2020 during the COVID pandemic. People were worried that if they go to their local Costco to pick up a roll of toilet paper, bulk of toilet paper, that they may contract a deadly virus that may potentially end their life as well as those they care about. In fact, life insurance actually had increases in sales last year because of clients looking and searching and trying to find people to help them protect them and their families. We think we're at the same forefront of a situation with Index Universal Life where people will be coming to you, knocking on your door or entering your virtual meetings to get these ideas and concepts about tax diversification and reduced future taxation during retirement, and also providing the coverage to help protect their family. So will the 7702 guidelines open up the IUL floodgates? To answer that question, first, let's talk about what prompted these changes. Now, the 7702 guidelines were set back in 1984, which defined how much premiums you could fund into a life insurance policy and still have all the tax favored treatment that the IRS has bestowed on life insurance policies. Now, at the time, they had a 4% interest rate that was more of a discount rate to calculate a future value, and that was what was used in life insurance pricing, again, to calculate the guideline premium limits and 7-pay limits a little shortly thereafter. Now at that time, actually January 1st, 1984, the 10-year Treasury was about at 12% and a completely different interest rate environment, right? Hyperinflation, high savings rates, high mortgage rates, high bond and bond rates as well. Now fast forward 37 years later, we're in a completely different interest rate environment. January 1st, 2021, the 10-year Treasury was under 1%. So again, interest rates have drastically changed. However, the 7702 guidelines were based upon a completely different interest rate environment. So what happened is the Consolidated Appropriations Act that was combined to within the COVID relief bill that was passed at the end of 2020 snuck in this provision through the lobbying power of our industry to update the 7702 guidelines to be more reflective of today's interest rate environment. Well, what prompted the changes? Really, it was the difficulty of most major whole life companies in offering competitive policies in this interest rate. If you think about it, their general portfolio yield was at or near the 4% interest rate guarantee of the old 70702 guidelines. They had to make sure that they can not only make a profit, but also provide policies that were beneficial for clients. Anyone who's competed against whole life recently have seen these proposals where you don't really see a lot of value there for the policyholder. These changes should theoretically help those struggling whole life insurance companies. So that's what prompted the changes, the lobbying power of our industry, low interest rate environment. What impact will this have? Well, first let's talk about whole life, because that's really why these new guidelines were passed. Now, really what that's going to do is offer less guaranteed cash value, specifically for those shorter pays like a 10-pay whole life. The trade-off for having lower guaranteed cash value is going to be greater non-guaranteed cash value growth based on current dividend scales. Now, from experience, most people end up buying whole life for the contractual guarantees. Whole life isn't really known to offer a lot of upside. So it's uncertain if this change will positively impact whole life sales, or they'll continue to see declines. Now, for Index Universal Life, again, this is more of a byproduct of these changes that were really affecting whole life companies. With the 7702 guidelines, what impact will that have? It'll essentially reduce the minimum death benefit requirement that exists because of the 7702 guidelines. Said another way, for the same amount of life insurance, our 7-pay MEC limit, our guideline annual premium will increase, allowing us to fund more premium in the same amount of life insurance. Now here at LifePro, we commonly work with our advisors on objections that they're getting for Index Universal Life. The most common objection we get is that the upfront policy costs are too high. Now, with these changes, by lowering the minimum death benefit requirement that the IRS will allow, that will reduce those life insurance charges and allow us to most likely sell and serve more policyholders. However, not only are the per thousand charges, the surrender charges, and the cost of insurance charges going to be reduced, but also for the advisor, they may also have a reduction in the target premium, the compensation. So the IUL carriers currently have a dilemma, and that's kind of what they're figuring out right now is, how do we not only improve the experience for the policyholder, but also make it fair for the distribution, you, the advisor? Do we give all the benefit to the client and just have the advisor make less? Or do we have a more balanced approach where we're also benefiting the client and also making sure that the distribution is made whole, or at least have competitive compensation for what they're offering? Now, these insurance companies are currently jockeying for position, and they don't want to be the odd man out and want to see what some of the other carriers are doing and want to make sure that they're going to be competitive in this new landscape. However, one insurance company has already updated their product to be 7702 compliant, and I want to share with you a case design example pre-7702 guideline changes and post, so you can see the difference that it creates. So for this example, I have a 45-year-old male, preferred non-tobacco, a $50,000 a year 10-pay, minimum increasing death benefit for the funding period, switch to level in year 11, drop the face amount as much as we can within the guidelines. Now, pre-7702, the minimum death benefit that the IRS required for this insured, this level of funding, was roughly $1.3 million. That's what the per thousand fees were based off of, the surrender charges, the cost of insurance, and also the target premium. Now, post-7702, the minimum death benefit is around $800,000, so about $500,000 difference in death benefit, or a change of 38% lowered minimum death benefit requirement based on these new guidelines. Now, what impact will that have on cash value? While it's important that we're protecting our policyholders with life insurance, most clients are buying this for the living benefits of the policy, the tax-free growth, the income tax-free access, and of course also life insurance as a cherry on top. So the internal rate of return on cash value growth in the 20th year was 4.74%, pre-7702 changes. Post was 5.10%, or a delta of 36 basis points. Now you may be thinking to yourself, well, 36 basis points doesn't really sound like a lot, but if you think about it, the average cost of all the policy charges over the course of the client's lifetime is usually around 1%. Give or take, every client's a little different based on the carrier or funding pattern or the insured health situation, but about 1% is the overall cost drag that all the charges represent over the client's lifetime. Now, if we're increasing the internal rate of return by 36 basis points, said in another way, we're actually increasing the cost drag by about a third. So taking that 1% down to about 2/3. Given that policy charges tend to be the biggest objection that prospects and clients have, theoretically, with better cash value growth, better internal rate of return, lower fees, we should be able to sell and service more policyholders. Additionally, most often clients are using this to provide a supplemental tax-free income to, again, hedge against future tax rate increases. And in this situation, same client, same funding, the illustrated income went from $72,000 up to about $76,000. Now, it's about a $4,000 difference on an annual basis, 5.51% change. But think about that over a 30-year retirement. That's $120,000 of additional tax-free income that this policy will be able to provide. That's a pretty significant number for our clients. The charges, cumulative charges at 95 went from $323,000 down to $310,000, which is a change of about 4%. Most of the cost savings were made up by a reduction of the per thousand charges, which are the upfront fees that are really could be a killer for the early cash value growth, and sometimes can cause a client to not move forward with these recommendations. And lastly, the target premium, the compensation, went from about $22,000 to about $14,000, which was a 38% reduction, which lined up perfectly with the reduction in the life insurance death benefit. Now, obviously, you can see that this benefits the policyholder, doesn't necessarily benefit the advisor. Per case, they make less on the transaction. We really believe that with these changes, plus everything going on in the macroeconomic level, that we'll be able to sell a lot more cases. Also, keep in mind that every insurance company is going to take a different approach. They may benefit the client with the 7702 guideline changes, or they may take a more balanced approach where they benefit the client and the distribution, which would be you. So again, to answer the question, will these 7702 guidelines open up the IUL floodgates? We strongly believe the answer is yes. And we're at this situation, kind of like I mentioned about the term insurance and the how life insurance previously was always sold, never bought. We really think that with these changes plus the macroeconomic environment going on, we'll actually have clients knocking on your door or entering your virtual meetings that understand these policies and understand the benefits of tax diversification and tax-free income and life insurance protection for their family. And we really think that we're at the forefront of a situation where clients will be very eager to move forward. Now, if you think about it, we've always talked about tax rates going up, or maybe the question of will tax rates be higher in the future? We know that tax rates absolutely will be higher. In 2026, the Tax Cuts and Jobs Act sunsets. We know that tax rates are going up for most clients. We also know that the current administration has said that they campaigned on this. If you make over $400,000 a year, we will raise your taxes. Our wealthy clients, our high income earning clients know this and are looking for solutions that are going to avoid future taxation. The new Biden tax plan may go in force as soon as 2022, which gives us this window of opportunity to talk to our clients about this oncoming freight train of taxes and this huge amount of government spending, $4 trillion deficit last year, maybe another $6 trillion this year with a new tax plan plus the infrastructure bill. But that's a lot of debt to be added on to our national debt and a potential big tax increase for our wealthy clients. So if you have any questions about the 7702 guideline changes, please feel free to contact your field support representative. We can actually send you a full comprehensive analysis on these changes, as well as provide you some tools and resources to be able to deliver this message on a virtual setting, get in front of more prospects, and talk about the importance of tax planning and tax diversification. With that, thank you very much. We'll see you next time.